the Bank of Canada is picking up the pace, making a big cut to its key rate.
We took a bigger step today because inflation is now back to the 2% target, and we want to keep it close to the target.
The central bank's interest rate down by half a percentage point to 3.75%, attempting to ensure the economy doesn't cool off too much.
We need demand to strengthen, take up the slack.
Cutting interest rates could get Canadians spending again.
When you have interest rates that are higher than neutral, what that does, that takes money out of the pockets of consumers because they have to pay a higher mortgage, they have to pay higher interest on their credit cards. That means they spend less.
Some homeowners feeling better after earlier rate cuts.
I've seen a drop of around $200, $300 monthly, which adds up to my budget, and I'm able to allocate money wherein I would previously think twice.
But high rates affect more than just mortgages.
So I believe if interest rates don't go back to sustainable levels, we're going to struggle in the long run.
Well, we're not even at neutral.
Some economists say the Bank of Canada needed to move faster.
And clearly, the softening in labor market is probably a big surprise to them. The speed at which it has softened, but also the speed at which inflation has come down.
If you look at the economy...
And saying they should have cut more before the U.S. election, because Americans can drastically affect Canada's economy too.
What happens in the U.S. will be a primary driver on whether or not we slow down more than what's expected in the Bank of Canada's forecast in 2025.
With economic growth already slow, the central bank will be watching how Canadians and Canadian businesses start spending before making their next decision in early December. Anis Haidari, CBC News, Calgary.
All right, next, let's bring in senior business reporter Peter Armstrong. So, Peter, Anis just mentioned December. What do you see happening next?
Look, the Bank of Canada is in something of a race here, right? It's going to try to get interest rates down as quickly as possible, and it hopes that it can do that in time and give itself enough time to stave off a recession. For the last 2 years, the focus was almost entirely on inflation. That's back to, and now even below the target. So now the concern is about growth and about the jobs market. The economy has slowed, the unemployment rate has ticked up, which is why the Bank of Canada made it abundantly clear today 50 basis points is not enough. More rate cuts are coming. We could be as low as like 3% by next summer.
So when we talk interest rates, we have to talk about the housing market.
We do. And remember that before today, we'd already cut rates by like 75 basis points, and the market was still flat. So the bigger issue on housing right now is construction. We simply aren't building enough. So for all those people that are priced out of the market on the way up, they're waiting in the wings. 50 basis point cut, that's really not going to address affordability.
All right, Peter Armstrong in Toronto.